Myra Sharma owns and operates a yoga studio, Green Yoga. Examine the following transactions and identify those that created expenses for Green Yoga. Prepare journal entries to record those transactions and explain why the other transactions did not create expenses. So they only want us to do the transactions for the ones that are for expense accounts. What we'll do is we'll analyze all of them, but we'll still do the transaction just for the practice. Okay? So, transaction A, paid $14,100 cash for office supplies, purchased 30 days previously. So which accounts are being affected here? Office supplies purchased 30 days previously. So 30 days ago, yeah, 30 days ago we would have debited our office supplies and credited our accounts payable. Today, we're just paying our bill. So it's cash and accounts payable. Are any of these expenses? No, so they wouldn't affect any of the expense section of the income statement. That being said, we'll still finish it out. So this would be the reason why, because it doesn't use the expenses. This is just exchanging an asset for a liability. Cash is going down. Accounts payable is going up or down?
Down.
Down. So how do we make an asset go down?
Credit.
And a liability? All right. So not an expense transaction, but because there's no expenses used there. Asset for liability. Paid the $1,125 salary of the receptionist. Cash and what type of expense?
Salary expense.
Okay. I would also accept wages expense, payroll expense. Oop. As long as I know what's going on in the exam. So is this an expense account?
Yeah.
And what's the difference between buying office supplies and paying for a salary? Like why is one an expense and one an asset?
Because it's creating an generation for own something. Like if we are buying the equipment and salary, we are paying it together. So we will be getting nothing in future for it.
Exactly. So you're paying your salary retroactively. It's already, the time has already passed that you're paying it. That time, that person working will never make new money for you, right? Whereas office supplies you'll be using regularly, and they will help generate revenue. That's the difference between an asset and an expense. So for this one, cash has gone up or down? Expense up or down? To make an asset go down, you must
Debit.
There you go. I'm sorry my writing is chicken scratchy, so hopefully you're listening as well as writing. Paid $45,000 cash for yoga studio equipment. So what accounts are being used?
Asset. Cash.
So cash and what, sorry?
Equipment.
Equipment, yeah. Or this might be studio equipment, or just equipment is fine. Depends on what other types of equipment they have. Is cash going up or down?
Down.
And studio equipment?
Up.
And is there any expense accounts used, or will this affect your income statement?
No.
No, because there's no revenue, no expense. So this is not an expense. You're trading assets for assets. Will the value of your assets change? Total assets change?
Yes, because previously we have bought office equipment, so it's kind of an asset.
And with this transaction, will this change your total asset?
Yeah.
Total?
No.
No, because you're exchanging one asset for another.
For another.
Correct. So, we're going to credit our cash, we're going to debit our studio equipment. Paid utility bill with 930 cash. What is the accounts being used here?
Utility bill expense and cash.
So close, yeah. Cash and utility
Expenses.
expense. Yeah, a bill is just the paper, right? Yeah, it's not the expense. So, is your cash going up or down?
Down.
And your utility expense going up or down?
Up.
Will this affect your income statement?
Yes,
And why does it affect your income statement?
because it's an expenditure.
And will your net income go up or down with this transaction?
Down.
Correct. They're good. You guys got this. All right. So how do we make assets go down
Credit.
and expenses go up?
Debit.
Let's do it. Again, if this was a real business, it would be like BC Hydro bill, invoice number, no. You would actually give like a reason to actually give an explanation. This is just because we don't really have that. 5,000 from the personal account for personal use. Which accounts are being used?
Equity and cash, like withdrawals and cash.
Yeah. And are there any, so is cash going up or down?
Down.
Withdrawals? It's actually, yeah, it's going up. So this is a contra. Again, this is one of those ones. Our equity is going down though.
Yep.
So we'll talk more about contras in a couple weeks. So we won't worry about it. Just think of it as equity. And so we're gonna credit and debit. Will this affect? Is this an expense? Does this affect expenses? No. Will this transaction affect our income statement?
Yes.
Yes?
Sure.
All right, so what makes up your balance sheet? What is the accounting equation? Yeah, so this is an equity, this is an asset. Income statement is revenue and expenses, so won't affect your income statement. Any questions?
When you withdraw, the equity's going down, right?
Correct, yeah. So withdrawal is a debit. It actually holds its value as debit because it's a contra equity, meaning it's the opposite of what it's supposed to do, and it still sits in the equity section. A little confusing. I'm going to explain it in more detail in 2 weeks after you do your smart reading. Any questions about this? Well, if you'd like to come back to it, this 9-minute and 15-second video is available on Brightspace.